Every month, the house rent allowance sits quietly on your payslip. For most salaried professionals, it is a standard line item that gets a quick nod before the money hits the bank account. But thousands of professionals are quietly making one of two very expensive errors right now. They are leaving tens of thousands of rupees entirely unclaimed, or they are overclaiming their rent in a way that triggers automated red flags from the tax department. HRA is the single most commonly miscalculated tax exemption in Indian personal finance. Getting the math wrong costs people real wealth, whether they underclaim and overpay taxes, or overclaim and face penalties. Ignoring how this allowance actually works turns a valuable tax benefit into a costly, automated financial leak. To plug that leak, we have to define what this money actually is. HRA is a specific component of your salary that your employer provides for one distinct purpose: covering your housing rent. But your employer's responsibility ends the moment they pay you that component. Converting that allowance into an actual tax exemption, the part that reduces your taxable income, is entirely your responsibility. You have to prove you spent that money on rent. That means either submitting rent receipts directly to your HR department or manually calculating and claiming the exact amount when you file your income tax return. The exemption operates on a strict use-it-or-lose-it basis. If you fail to act, that supposedly tax-free money instantly converts back into fully taxable income. Calculating that exemption is never a guess, and you cannot just claim the full amount your employer gave you. The legal exemption is always the absolute lowest of three specific calculations. Box 1, actual HRA your employer paid. Box 2, total actual rent minus 10% of basic salary. Box 3 sets a geographic cap, 50% of basic for metros, 40% for non-metros. Your exemption is the absolute lowest of these three. Bypassing this exact three-step formula guarantees a mathematically incorrect tax return. You will either underclaim your benefit or claim too much and invite severe tax scrutiny. There is a widespread misconception that if you live in a house owned by your parents, you are entirely disqualified from claiming HRA. Legally claim this by executing a formal rent agreement and paying your parents monthly via bank transfers. You receive the HRA exemption, lowering your tax burden. Your parents declare the rent as income, absorbing it with almost zero tax impact due to their lower bracket. To do this legally, the rules are non-negotiable. Payments must be digital or by check, the documentation must be formal, and your parents must officially own the property. Properly executing this legally protected wealth transfer saves families earning 10 to 15 lakh rupees, up to 1 lakh in avoidable taxes every year. Let's run a real-world scenario to see the exact cost of getting this wrong. Take a professional in Mumbai, earning 12 lakhs a year. Basic salary, 5 lakh. HRA component, 3 lakh. Rent, 30,000 a month. Actual HRA is 3 lakh. Rent minus 10% of basic is 3.1 lakh. 50% of basic is 2.5 lakh. The exemption is the 2.5 lakh minimum. Leaving this fully taxable loses 94,000 rupees. Failing to run a 5-minute mathematical equation results in the silent, completely avoidable destruction of nearly 1 lakh rupees of personal wealth annually. The reason you cannot guess or fake these numbers is because the Income Tax Department has deployed a modern technological net called the Annual Information Statement, or AIS. This diagram illustrates how the AIS automatically cross-references your financial life. It pulls data streams straight from your employer, your banking transaction histories, and your landlord's PAN card. Capturing the landlord's PAN is strictly mandatory for any rent exceeding 1 lakh rupees a year. And if you attempt to fudge the numbers, the system has the authority to audit your historical data up to 6 years back. The era of quietly overclaiming rent without solid documentation is over. Systemic data matching has turned scrutiny notices from a rare occurrence into an automated certainty for anomalies. To protect your income, follow a simple 4-step protocol. Step 1. Bypass manual math entirely. Use the dedicated HRA calculators available on the official Income Tax Department portal or ClearTax. Step 2 and 3. Rigorously collect your monthly rent receipts, secure your landlord's PAN for amounts over 1 lakh, and formally draft real legal agreements if you are utilizing the parent rent strategy. The final step. Proactively log into the AIS portal and check your statement before you file any returns. Verify exactly what financial data the government already possesses. dedicating 15 minutes to running the proper formulas and securing your documentation permanently seals a massive tax leak. Do not let this allowance sit idle on your payslip. Share this playbook with young professionals renting in new cities, because they are unknowingly leaving thousands of rupees sitting completely